in the nation's capital, let's hit some financial news, specifically the latest on rate cuts. A big announcement from Fed Chair Powell earlier today. I'll let Connor Hansen explain.
There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
The Fed votes to make its third and final cut of the year, once again taking it down by a 1/4 percentage point. Investors watched Chairman Jerome Powell's speech for clues about where things will go next year, and it appears rate cuts could be harder to come by.
We are well positioned to wait to see how the economy evolves.
President Trump has been hounding the Fed chair for not making cuts sooner.
Jerome, too late. He's too late with his interest rates. Got to get the rates down, you schmuck.
Some board members dissented. 2 wanted to pause rates, and 1 wanted an even deeper cut. The latest decision comes as the president pushes his economic agenda for 2026. Despite some positive trends, Democrats are seizing on a drop in consumer confidence.
Donald Trump and Republicans have done nothing to lower the high cost of living. Costs haven't gone down. Costs are going up.
Democrats talking about affordability is like Bonnie and Clyde preaching about public safety.
President Trump will soon have the chance to replace Powell. Many see Kevin Hassett as the clear frontrunner for the job. The current director of the National Economic Council has stressed that he would keep the Fed independent.
They've got plenty of room to cut rates. They'll do a little bit this time, but they'll probably need to do some more.
Hassett says he expects the president to make his decision on who will be the next Fed chair in the next week or 2. In New York, Connor Hansen, Fox News.
Okay, so let's discuss more. By the way, we continue to track the latest in D.C. Standing by here, Talley Leger, he's a chief market strategist with the Wealth Consulting Group. He joins us. Let's get into this. So given that the Federal Reserve is cutting its benchmark rate to the lowest level that it's been at in nearly 3 years, this was a divided vote on the Fed's part, Talley. So what does this signal about the Fed's view on the balance between inflation control and, at the same time, supporting the labor market?
Austin, judging by the minutes today, or at least the FOMC statement that was released this afternoon, it looks like we've got 3 dissenters, and it was really the 2 that voted for no change in the policy rate that I think was alarming. And when I take a step back and I look at job growth in this country below 1% year over year, which is weak, plus a headline consumer price inflation rate of 3%, which is actually below average back to the early 1900s. Meanwhile, you got a policy rate that's still up around 3.5 to 3.75%. I think there's scope to reduce rates even further, Austin.
You know, the Fed's own projections for 2026 are calling for just 1 more 25 basis point cut, despite pressure for further easing. In your opinion, what risks or data tipping points do you think could push the Fed to hold rates or even reverse course next year?
Well, I'd be on the path here of continuing to lower the federal funds rate because it's still in restrictive territory. Even considering today's 25 basis point cut, the policy rate is still a good 0.75% above headline consumer price inflation rate. And when you look at trueflation, which is probably closer to 2.5%, again, I think it argues for a downward trajectory in the policy rate. So my personal argument would be to expect more from the Fed in 2026.
You know, we did hear from Fed Chair Powell, as we typically do when he makes these announcements. The Fed chair earlier today basically stepping up to the podium, explaining his thought process. Some members of the policy setting committee, the Fed, asked for a bigger cut, Talley. Others, as you and I have alluded to, voted to leave rates unchanged. So how do these internal divisions reflect deferring economic forecasts? And more specifically, what does it mean for long-term policy stability?
So I think a lot of economists, and it's understandable, got head faked or whipsawed by their forecasted expectation of the inflationary effects of the tariffs. as a firm, we haven't been there. We've been very cool-headed because history shows that the tariffs are deflationary. Why? Because they're a tax hike. You got to go easy with the tariffs because they're a brake on growth. So again, I think the broader trend here for inflation is to come down. And once more policymakers realize that the underlying trend for inflation is lower, not higher, I think they're going to cave and kind of fall in line here with further cuts.
So really one thing that I always love to ask our guests whenever we hear of Fed cuts, or rate cuts, I should say, is how exactly does this impact the average American's personal finances? So with borrowing costs likely to fall, but returns on savings also dropping, Talley, what should households, what should borrowers, what should investors now be thinking about in terms of mortgages, credits, savings, and risk?
Well, that's the most important question. Thanks, Austin. So I would say in the aggregate, consumer or household balance sheets are in great shape. This is good news for Americans. Net worth is at or near an all-time high, which is mind-boggling given all the pessimism and negativity out there in the consumer inflation, the sentiment surveys and the like. So I would say, look, when it comes to this finance-based economy, there's more in tow for consumers when we consider the lower cost of auto loans or the potentially lower cost of mortgage rates. And you could add to that too the drift downward in gasoline prices. All these things together, I think it liberates cash flow or money in the consumer pocketbook for additional discretionary expenditures.
Where does this story go from here? What financial bellwethers, what economic indicators are you watching for as the year closes out?
So I love the discussion here we've been having, Austin, about interest rates. I think that's a crucial impact for the stock market in a positive way through the valuation channel. And it's one of the elements that we consider when we have or form our bullish outlook for the stock market next year. Part of that, a particular sector, would be the consumer discretionary space, which would be a prime beneficiary of all those major macro tailwinds that we just walked through. So keep an eye on that one, Austin.
All right. Talley Leger is a chief marketing strategist with the Wealth Consulting Group. Thanks for coming on.
My pleasure.